Well, hello there, ladies and gentlemen. Good to see you again, and welcome back to Advance Your Wealth with Homer Smith. I'm Ryan Ruff, your moderator, and as always, I'll be joined by Homer in just a moment. But we want to set the scene on a great wealth management related discussion here for today's episode. Today, we're going to be diving into 5 different ways to ease the tax bite when selling your business. And to kind of set the scene for you all today, look, selling a business, it's a tall task, right? And you've worked so hard to build that business up, to allow it to really generate the level of profits and success that you've seen. But when you sell a business, there are enormous numbers of considerations at play, not the least of which is making sure that you ease that tax burden when the sale comes about. Now, fortunately, this is something that Homer and his team have been working through diligently and a lot of these sales of businesses of late, and we'll get into that in a moment. But today we're going to be looking at these 5 different ways that you can mitigate that tax bite when it comes to selling your business so that you and yours come out better for it on the backside of that sale. So with that being said, let's go ahead and welcome Homer aboard. Homer, good to see you today. How you doing?
Hey Ryan, great to be here. Super excited for this topic. As you mentioned, we've been spending the last couple of years doing a lot of this work for our clients, and have gone down the rabbit hole on these plus many others that we won't even get to today on ways to help our families and business owners think through all this. So excited to discuss this.
Yeah, yeah. Well, hey, let's start high level like we typically do on the show. Look, tax related issues and questions are, I would imagine, kind of the top of the mind for a lot of entrepreneurs out there. So why don't you set the scene for us? Talk to me about your conversations with business owners when they're approaching this idea of the sale and how it relates to the kind of the tax burden that's going to come into play.
Yeah, I appreciate it, Ryan. I think I'd also like to start too, just with a high level thought around what we do at Convergent, in our family office group, around just what we're known for. What we're known for more than anything else is helping our successful families and business owners, navigate life's most complex transitions. And obviously, a sale of a business fits into that. It also could include just before you sell a business, moving from owner operator to owner and taking a step back from the day-to-day operations of that business. It could be, instead of an outside sale, which we're going to focus mostly on today, it could be a transition to the family, the next generation within the family, or it could be a transition to the management team internally. And then finally, what we're going to focus most on is what would an external sale look like, and what are some of the techniques we can do from a tax planning standpoint around that. And then I think another huge one that often gets overlooked in this process is what do you do with all that wealth once it's in your pocket? You've been managing this business. Many times, most of our clients are founder-led businesses. This has been their baby. They built this thing up 20, 30 years. It's been their identity, and now they're moving away from that. How are they going to live and have a purpose for life after the business? And then ultimately, how do they transition this wealth to their family and their heirs in a way that's going to be positive and impactful and not destructive? So there's so many things that go into this discussion, and we're obviously going to focus on one that I think is most top of mind, which is taxes.
Mhm.
But this is such a critical conversation, and obviously the taxes are typically at the heart of it. But yeah, so many ways this can go. So excited to really dive in.
Yeah. All right. Well, let's get started. And I think the good place to start is kind of in a chronological order, if you will, as you go through the sale of business. So, talk to me, Homer, about some of the pre-sale strategies that exist out there. What's the first one that comes to mind?
Yeah. So as I think about pre-sale strategies, I also want to bring up why this planning is so important to do as early on as possible. Before we dive into the first strategy, in some of the research that we have done, what we know is that for business owners that are actually ready to sell, say, hey, I'm ready. I'm raising my hand. I want to sell my business. Only about 20 to 25% of them are able to actually complete the sale of their business. And then of those 25% that complete the sale, in surveys that we've done, only about 12% of them say they were highly satisfied with the outcome. So if you put those two together, what that means is only about 3% of business owners who start the process to sell their business end up highly satisfied with the outcome. And one of the key reasons we believe that they don't end up highly satisfied is they didn't do the work far enough in advance of going to market to really understand all of the different outcomes that were going to happen related to taxes. How are they going to able to replace their lifestyle outside of the business, maximizing the value of the business prior to the sale. Other things, again, we're not going to focus on quite as much today, but the tax planning component is a huge part of it. And so I think it's really important to start this process early. I think too often, either your wealth management team or your tax team is brought in once an LOI is already in hand and signed. And by that point, it really is too late to do much of this planning. So, I really want to emphasize the real importance of starting this process as early on, as soon as you're thinking about selling, about the idea of it, is to start this conversation with your team. So
Mhm.
sorry to jump into that first round, but I think that was a really important
No,
part to bring
I
up.
agree. I agree. So one that I know you and I have touched on Homer in the past, and one that's worth diving into is kind of the Section 1202. Why don't we lead off with that in terms of a pre-sale strategy, and we'll roll through those five that we mentioned.
Yeah, great. So what you're referring to, Section 1202, or what maybe you've heard of, something that's called qualified small business stock. So, again, which is why setting up your company in advance and having these conversations in advance is really important, because there's a tax code, this 1202 tax code, that for if you set your corporation, your company up as a C corporation, and you're in certain types of industries. So there's certain businesses that don't qualify for this, but if you're in the right type of a business and you set your business up as a C corporation, and with a few other rules, but the main other rule is that your corporation is in existence for at least 5 years. When you go to sell your company, the first $10 million of gain can be completely federal capital gains tax free. So that's a huge advantage. And then through other planning techniques, you're able to, I guess, add to that benefit by gifting shares in the business to your spouse, to your kids, and in other ways that you could turn that $10 million exemption into 30 million, 40 million, $50 million of a tax-free sale, at least in the corporate or the federal capital gains level. But again, you have to do this planning in advance. But if your business would qualify, it's extremely powerful planning and a huge tax savings on the sale.
Sure thing. Well, Homer, another big one. I know we've talked trusts in past episodes, but another big one I know you and your team work with are charitable remainder trusts. Bring that back into the fold for those that maybe just didn't have a chance to check out our episode on trust. But how does that factor into the sale of a business, or at least the pre-sale?
Yeah, so trust planning and charitable planning is a huge part of what we do with our business owners. And I think that the first point I want to emphasize is this strategy only makes sense if you are charitably inclined. And we try to make sure with our clients that we don't let the tax tail wag the dog. And while this does have significant tax benefits, you are doing a significant gift to a charitable trust that limits your access to those funds. And so, making sure you have charitable intent is really important. So with that, the benefit of this strategy, and again, how your business is structured matters a lot with the ability to utilize this strategy. But if your business is structured in the right way, you would be able to transfer shares of your business into a charitable trust prior to the sale. And first off, you would get some level of a tax deduction for transferring the value of your shares in. It's not significant because of the way these trusts are structured, but you would get a small tax deduction for putting them in. The bigger benefit, though, is that at the sale, when the business does transact, those shares that are held inside of that charitable remainder trust would not be subject to federal or state capital gains tax or income tax of any kind on those shares when the business is sold. However, you would be subject to tax as you take an income stream from that trust. So one feature of a charitable remainder trust is that there's an income component back to the family. And so, for example, if your business owner, if you were 60 years old when you complete the sale of your business and you ended up having 10 million go into your charitable remainder trust, you might elect to have 7% of that trust come back to you as income every year. So in that example of a $10 million trust, you'd have $700,000 of income coming back to you each year from the trust. And the way that you would be taxed on that is based on the taxes that were deferred inside the trust of the sale. So most of the time, it's going to be capital gains. So you'll be receiving, your income back on an annual basis and being subject to capital gains tax. But the huge benefit of that is that 10 million that went in was not subject to income tax on the sale. So using California as an example, where we have a lot of our clients, if you account for federal capital gains and state income tax, that 10 million would have been reduced to 7 million or less at the time of the sale. And so that would be $3 million or more or less dollars working for you, creating income, where inside of the charitable remainder trust, you have all 10 million. And so that income stream is going to be a lot higher. But in that case, it really is a deferral, but it's a significant benefit to defer those taxes over the long run with that. And another big benefit of it is if you manage the money well inside of the trust. There would be a significant amount remaining that would go to your organizations that you care about, the charities you care about, at a certain period of time, whether it might be 10 years, 20 years, or at your death. So a lot of ways to work with
Mhm.
those strategies to create some benefits, but the tax deferral on the sale is pretty significant.
Yeah, absolutely. And you kind of already started a beautiful segue into where I was going to take this, and that is, are there any additional, not only just trusts that could be leveraged, but gifting strategies that could be helpful to, you would think, gifting strategy should be something that's allocated after the sale, after I have that, liquidity event, but actually it's something that should probably be navigated ahead of time. What does that look like, Homer?
Yeah, 100%. And we can even tie it back to the charitable remainder trust as well, because there's two types of taxes to consider on a sale of a business. There's the income or capital gains tax, which most people focus on because that's the most immediate impact from a tax perspective. The other side is estate taxes. And as the value of your business grows, the larger of an impact it will have on estate taxes for you and or potentially for your family in the future. So one benefit of the charitable remainder trust, in addition to the deferral of the income taxes on the sale, that 10 million would also be out of your estate and not subject to estate taxes. So huge savings there. But there's other giving strategies that you could do pre-sale that could, at the very least, eliminate the estate tax associated with it. So for your family, for instance, we have a lot of clients that the intent is to pass their wealth on to their kids, and they're also still in a position where their business is growing and it's not reached its maximum value yet, where they're ready to sell it, but they plan to get it there. And there's advantages to gifting value in the business, out of your estate into, typically into some sort of irrevocable trust for your kids and future heirs, where you can get it out of your estate at a lower value today. And so all of that excess growth would occur outside of your estate. And in addition to that, because businesses are private, privately held, they're not easily marketable. You can often get some pretty significant discounts when you're doing that kind of a strategy, where you can get more than your current lifetime exemption, which is right about 13 million today. You can get more than that $13 million out of your estate due to the nature of the structure of that business. So it can be pretty valuable planning, and depending on, again, the structure of the business. There also could be some income tax benefits to that structuring as well. Just again, it depends on a case by case basis. But at the very least, dramatically lowering future estate taxes by having the future growth of that business occur outside of the estate.
All right, so we've got three pretty big pre-sale strategies in that Section 1202 small business stock you mentioned, charitable remainder trusts, and then of course some of those gifting strategies. Homer, let's shift gears now. Let's talk post-sale. What's one of the first big strategies and conversations you're having with business owners that they could be leveraging to kind of curb that tax bite when it comes to after the sale, after that big liquidity event?
Yeah, the biggest strategy we've been having conversations with every client after the sale of their business has been around qualified opportunity zones, and these came into existence about 6-7 years ago with the last major tax code changes, where each state got to identify areas in their state that they wanted to have investment dollars come in to help revitalize. And so as part of this federal program, if you were to take assets that have capital gains or gains associated with them in a sale, you could invest those dollars into an opportunity zone and defer the taxes from that on those assets that you move in, or those proceeds that you move in, at least until your 2026 taxes, which means typically wouldn't be paid until April of 2027. And so today we're near the end of 2023, depending on when you're watching this. That's about a 3.5 year deferral of all the taxes that would be due for the assets that go into that structure. So if we think about it from an easy math standpoint, for every $1 million that you would put in there, at the very least, you're likely saving a couple $100,000 in taxes up front, or deferring a couple $100,000 in taxes up front. Typically, they're not recognized at the state level, so it's just a federal tax deferral. But if you're a business that happens to have higher taxed assets, so equipment or buildings that are going to be taxed at a much higher rate, as high as ordinary income, it can be a pretty significant deferral. on the sale to utilize an opportunity zone. The other major benefit, so beyond the deferral at the sale, which is a nice
Hmm.
benefit, but by itself, probably wouldn't be enough. The other major benefit of this is that if you hold those assets inside of the opportunity zone for at least 10 years, any of the growth that occurs in those assets over that 10 years would be tax free when you ultimately sell those assets out of the opportunity zone.
Oh,
So,
wow.
again, that another simple math. If you put $1 million in and over 10 years it grows to $2 million, the $1 million of growth that occurred would be tax free. And there's one additional final benefit that you get
Yeah.
depending on how you structure it and what you're investing in. But typically, people use real estate as the investment inside of the structure. And with real estate, one advantage of real estate in general is that you can take depreciation. And when you take depreciation, it helps make your income off real estate more tax efficient. And within the opportunity zones, you get that same benefit. You get to take the depreciation on the invested capital that you put in. The downside to that structure is that ultimately, when you sell that real estate, you have to recapture that depreciation, unless it's inside of an opportunity zone. So not only do you get the tax-free growth of that asset, but when you sell it, you don't have to recapture the depreciation on the initial capital you invested in. So, three different levels of tax benefits
Hmm.
inside of the use of an opportunity zone. The one downside is you got to leave it in there for at least 10 years.
Hmm.
And so if we just happen to be in a real estate cycle where there's not any significant growth in real estate and that capital could have been invested somewhere else, you only really ended up with a deferral on the front end of the taxes for a few years, and then maybe limited your upside because you couldn't go invest in other things. So while I do think there's some pretty significant tax savings, it really does have to align with the goals of
Hmm.
the seller and make sure that they're comfortable with that length of a hold and inability to access those dollars for pretty much any reason for that 10 years.
Yeah, really interesting with the, the different variations that they can lean on with the opportunity zones. Obviously, everybody's strategy and situation is going to be unique to them. So, this is one of those moments where we always recommend somebody have a conversation with their trusted advisor to talk through what solutions make the most sense. But Homer, and kind of switching to our fifth and final big, area and avenue of conversation on these strategies that can kind of mitigate that tax bite when they sell a business. Look, we've had conversations on this show surrounding life insurance, how it's not the hottest topic that everybody wants to talk about, but there's real value that lives inside of life insurance solutions. So, what do you see on the life insurance side of things to kind of round out today's discussion?
So Ryan, if I were to ask you, like, if you had a pile of money, whether it came from a sale of a business or inheritance or whatever it might be, and I could say, look, if you could invest a portion of those assets in a structure, like right down the middle of the tax code, but that structure would allow you to never have to pay tax again on the growth of the investments or any of the income off of your investments. But you could have the same flexibility on how you invested those dollars if you're working with an advisor. And not
Mhm.
only would it be income tax free, but your heirs would not pay any tax on the life insurance associated with it or the assets that would come out of that structure at your death. Is that something that you'd be interested in?
Well, there's a lot of benefits you just rattled off there, Homer. So I'd have to say yes.
And so this structure, you mentioned life insurance, is it's a strategy called private placement life insurance, and this is effectively a strategy that single family offices, so billionaire families, 30, 40 years ago, looked at the tax code and said, hey, we really like how life insurance provides a lot of tax benefits for the assets that are inside of life insurance. What we don't like is being subject to the very limited amount of investments that the insurance company provides and the level of fees and commissions that are associated with life insurance. So, could we take advantage of this tax code, but structure it in a way that's more beneficial for the long-term growth of the assets, in addition to the life insurance benefits that it provides? And that's where private placement life insurance came from. So, families with, at least 10 million of liquid assets are now able to access this type of a benefit where you have to work with a third party advisor to manage the investments. But if you're already doing that, what this structure allows is for you to have your advisor manage the money the same way they would otherwise effectively, and avoid all of the tax on the growth income of that portfolio. Another big advantage of it, and again, we have a lot of clients in California and other high tax states, is there's a lot of investment structures that we would never even really consider for a resident of a high tax state, just because of the tax nature of that investment itself. And so there's certain really advantageous vehicles that just may not be available or make sense, but inside of the structure, all of a sudden, because of the tax benefits of it, we're able to bring that back in. And the same structure, because it is life insurance, can provide some significant estate tax liquidity as well if you set it up outside the estate. And a lot of liquidity in general. So these wealthy families need that kind of liquidity, and so the life insurance component of it also is very valuable, combined with this ability to structure a portfolio that can eliminate all of the taxes that can come. Again, you have to structure it well. You have to have the right team around you to put this together. This is not something that is off the shelf and is easy to manage. You got to have the right team, but if you have the right team that can put this together for you, when I'm talking to families about all of the ways we might be able to save on taxes on the sale itself and some of the complexities that have to be involved in doing that, sometimes it's like, at the end of the day, it's like, hey, sometimes it's better just to pay the tax on the sale, get your assets free and clear, and then be able to utilize a structure like this where you never have to pay tax again for the rest of your life,
Mm,
on that component of it, right? The portion that goes into that.
sure.
So it's a strategy I think that we've seen that's not rarely discussed with families going through these liquidity events, but one that we've had a lot of success with, and that we definitely see clients very interested in, and at least having the conversation around it, around the sale of their business.
Well, yeah, I mean, no, there's a lot of value there. Again, interesting conversation should your circumstances kind of align with leveraging that solution. But Homer, as we're kind of bringing our conversation to a head, I think a common thread among this whole conversation of selling your business is that there are numerous considerations at play here. For you and your specific situation, and ultimately conversations on how you want to mitigate that tax bite and how you want to really maximize the value of your life's work. Well, ultimately it comes down to proper planning, and that
Yeah.
means plannings that should planning process and conversations that should start early. So if you had any one big key takeaway for somebody from today's episode, what would it be?
So I think in addition to starting early, which we already discussed previously, building the right team to take you through this process matters a lot. I mentioned earlier that if you add up the only 20-25% of owners who start the process, complete a sale, and then only 12% of that 20-25% is highly satisfied with the outcome, in addition to just maybe being frustrated with the taxes associated with the deal or not getting the full value, is that the team that they put together did not bring the value that they were planning for. And assembling the right deal team that includes the right attorney, the right investment banker or broker, the right wealth management team, the right tax team, all of these components are really critical, that team can work together collaboratively and cohesively for you, as the owner, to make sure you get the outcome that you deserve from this process. And I've seen it both ways. I've been brought in, just to support an owner in the process, and seen that the other components of the deal team were not necessarily looking out for the owner's best interest, and they didn't get the outcome they were hoping for. While at the same time, I've been a part of deals where we were able to assemble the team along with the client well in advance, make sure everybody was on the same page, and got a fantastic outcome for the client. Obviously, having the right deal team doesn't guarantee that kind of result, but I definitely believe that putting the right deal team together, that can be that collaborative, cohesive unit, is going to give you the best chance at getting that outcome that you want.
Well said, Homer. Well, for anybody out there, Homer, that hears this conversation surrounding selling a business, and should they find themselves in that position and could, benefit from a second opinion or just opening up a conversation with you and your team, what would be the best way they could start that dialogue?
I would definitely encourage you to reach out, visit our website, reach out and have an introductory call with me. Again, this is what we specialize in. This is what we basically spend all day, every day doing, is working with families and business owners thinking about or going through a transaction, and how to then manage the other side of it. And so we've seen, pretty much about everything that you can see when it comes to these types of deals. And so would happy to, again, at any point, second opinion, a second pair of eyes on what you're thinking, and happy to give you some thoughts on what we would suggest you do from there.
Fantastic. Well, Homer, look, I appreciate you carving some time out of your busy schedule to jump on board here and get into these tax solutions. But we'll let you get back to serving your clients and do what you do best. But thanks again, and I'll see you on the next one.
Thanks a lot, Ryan. Good conversation.
Yeah, of course, of course. And hey, folks, as we always do on this show, we're going to take a final moment and thank you all for stopping by and spending some time with us. If you took something away from today's discussion on mitigating that tax bite when selling your business and you learned a thing or two, well, make sure you go ahead and subscribe to the show on whichever platform you checked us out on today so that you don't miss out on future conversations like these. At the end of the day, Homer and I are breaking down some of the wealth management discussions and topics that he and his team of professionals, as well as he and his clients, are having on a regular basis. And we're just bringing them right here to you guys to unpack the same conversation in front of you. So for Homer, I'm Ryan. We're going to go ahead and say so long today, but we appreciate you stopping by and being with us on Advance Your Wealth.